Friends, welcome to PARDES. It's a trialogue on FEMA. We are on episode 10 today. Today's day is very special and very important for one reason. This is a very common topic in foreign exchange management, export of goods and services. And it is most common for any entrepreneur, whether he is a present exporter or a prospective exporter. Any micro, small, and medium enterprises today, tomorrow they will be a large enterprise. So, let me welcome each and every one of you and also welcome two eminent personalities with us. CAVV Sampath Kumarji. Sir, thank you very much for accepting and gracing today's session. And also we have with us Madam J. Lalita, an ex-banker with years of experience on foreign exchange management. Let me hand over the session to Sampath Kumarji and then request him to lead the session. Over to VVS, sir.
It's always very satisfying to share our knowledge for the benefit of the great audience. At the outset, season's best greetings to each one of you. Dr. Raju, Gopalakrishna Raju, is a chartered accountant, company secretary, cost accountant, resolution professional, insolvency professional. It goes on. He has got a passion to share knowledge and also the nice nitty gritties of whatever he delivers, he takes us through. Equally, Madam Lalita is an ex-banker with rich experience of more than 3.5 decades with banking experience, more so particularly in a pointed manner in respect of foreign exchange. I'm very glad to be with them to take you all through the topic for the day. Foreign exchange management, export of goods and services regulation 2015, which is there for the past 7 years or so. I had the doubt by seeing this particular regulation whether this is applicable even today with amendment or without amendments. The experts in this field are more equipped to deal and refer and observe about the continuance, and wherever there are changes they will highlight about it. At the outset, I would like to ask Dr. Raju, what is meant by the term export as per these regulations, and is there any declarations that are to be submitted as an exporter? Over to Dr. Raju.
Sir, thank you very much for this opportunity. First of all, as a regulator, Reserve Bank of India as a regulator, whenever there are cross-border transactions, I repeat, cross-border transactions, normally export of goods or services means there will be cross-border of goods from India to outside India, and there will be transfer of funds from outside India to India. So that means there are two regulators or two government bodies are involved in this. One, as a money market regulator, Reserve Bank of India will be regulating the money which has been brought into India because of export. Second, there is another government agency which has to monitor whether the goods has been exported. Sometimes you export and receive money. Sometimes you receive money and then export. We call that as advance received for export. So both this are to be, that means there are two regulators or two authorities are involved with respect to exports. That is the first thing, first clarity we need to have. And in Reserve Bank of India, under Reserve Bank of India, when they monitored through two guidelines, I must say one is the foreign exchange management, export of goods and services regulations. Another one, that regulation is for the exporters. Then for the authorized dealers, that is the bankers, who will be receiving the money from abroad on behalf of the exporters to be credited to their account. So the for the bankers, the master directions are issued. Now, point one to be understood is what is export, and especially we need to be very clear with the service exports and goods export. For example, when the software is exported outside India, because even it can be a consultancy. A consultancy has been made, a service is given, and a bill is under invoice is raised. Software is sent outside India, you develop here and send. So both are unique, both are different. Goods and service both are different. So export of goods alone is defined. I repeat, in the regulation, export of goods alone is defined. That also include sometimes software you will load in a device, in a CD, in a DVD. Those days, now it can be in a pen drive or any magnetic device. For example, a hard disk, and then you export. So then that is also goods. A software which is saved, which is recorded on a magnetic device, and then the device is sent outside India, that also will come under export of goods only, because they say, and also includes transmission through any electronic media, and export of goods by land. So that means you cross the borders from one country to another country by sea or by air. So all the three mode is export. Number two, most important, VVSG was asking about the declaration. Every export, there is a form which has to be voluntarily declared by the exporter to certain authorities, especially if it is software export, that is services, then there are certain authorities to whom we have to give declaration. And with respect to goods, we need to give the declaration to the Commissioner of Customs in a form called Form EDF. That Form EDF, now it is all the forms in olden days, that means exactly 5-6 years back, it used to be physical form. Nowadays, all the forms are electronic. But I want to make one observation here. There are ports, we say airport and seaport. There are two types of ports. One is called EDI port, non-EDI port, electronic data interchange. Majority, 98% of the ports are EDI ports. That means the ports and the Reserve Bank of India server, both the servers are interconnected. But what is non-EDI port? You submit the form to the Commissioner of Customs. That particular form has to be keyed in, and then it has to be uploaded or synced with the RBA server. That will take time, maybe 1 week or 10 days. So EDI port, non-EDI port, most important. Second, very relevant point is how much of value of exports are considered in EDI ports. Only 65%. 35% of the value of exports still are done through non-EDI ports. Over to VVSG.
Dr. Raju, you have mentioned about the applicability of the form EDF in respect of goods and non-EDI or non-goods, which is services. You have quoted an example of a software also in this regard, which also takes little time. I would like to make an observation in respect of software. Software has been held to be a commodity for the purposes of levy of taxation in India. But I don't think so. The same categorization is applicable in respect of export of services, which is software. That apart, I want to make the distinction in classification of software under the taxation laws in India and for the limited specific purposes of export of services like software in a cross border transaction. Everybody need to have the distinction. Madam, Raju highlighted about the applicability of the declaration in a particular form in respect of certain export of goods or per se which is applicable to services. What are the situations in respect of which the declarations are not required when there is an export transaction, madam?
Yeah, thank you. Um, what we need to understand is like, why do we need to give a declaration, first of all? The government of India should know these are the resources, natural resources of the government of India. Exports are done by somebody, some exporters. They can't say these are the goods I have sent. Nobody should ask me any questions. Everything has to go through the, the radar. The radar will be watching about. It is being scanned through. Everything is being scanned through. Whatever is going outside India, so that the equivalent foreign exchange comes into India. That's the idea behind it. So that is the reason the government of India, the RBA insists that there should be an export declaration form. There's a statutory declaration form, and then it's all, as Dr. Raju said, this is voluntary. What does it state? It states that these are the goods or services, whatever, because when you look at the MD, the master direction, it is applicable for goods, software, and services, right? So, of course, for software exports, it's a different format altogether. That's different. We are not discussing that. But when these EDF forms are filled in, what does it state? It states these are all the goods sent to these places, and I declare that the proceeds will be realized within the specified realization period in foreign exchange, that equivalent value of the goods, right? That's the idea. So that means where there can be exemptions can be there where you are not going to realize any value of foreign exchange. As simple as that. So, like for example, what it's a sample. I'm participating, or I got a new client. I'm doing some sales promotion activities. I'm an exporter. I'm sending a straight sample. So then what do? I go for an EDF waiver form. Like it's an invoice which is prepared and it will say equivalent no value. And this is a waiver of EDF. We get it attested, approved by the AD. Then only it is submitted to the customs. That's one. So it can be samples. Or I'm a traveler, so I'm taking along with me certain personal effects, or after I travel or before I travel I send my personal effects beforehand only, like this happens for all big wigs or maybe celebrities. They send all their personal effects. They don't change the brands, they don't change the items, the whatever they have been using, they want to use that wherever they go, whichever be the part of the world. Third one, very important, is where the government of India, the central government, has asked you to do some sort of a transshipment in the ship itself, like it's a demand from them, it's an instruction from them, it's for military or for any air force or naval or any requirements, right? So these things do not require an EDF form. I'm an exporter, and when I go to visit somebody, my clients there, I want to give them some gifts, provided the value of it does not exceed 5 lakhs Indian rupees. I don't need to submit an EDF. There are items like aircrafts or aircraft engines or spare parts, they are all they are all sent abroad, rather they are exported abroad only for repairing. It must have been imported. It must have been a Boeing or some specific Airbus, or it could be any aircraft, right? When it is imported from there, and for any repairing or anything, for everything, they can't come here and do it. Okay, there are certain parts, spare parts or engines, which can be exported. It will be exported there. The repairing will be carried out abroad, and it will be imported back, right? But only condition is that. Um, this is all in case it is an export from here, right? From the date of export, after I do an export of it, and then they carry out some, there is some problem, then you need to re-import it. So the time gap, whatever may be the case, the time gap cannot be more than 6 months. This is one. There, and basically, whatever is imported, with a condition that we will be re-exporting it, we'll be carrying out certain things here, or maybe it's for participating in similar trade fair or any industry expo or anything in India. Or there are certain things like once I import the goods, I found that these are not in proper working condition, they are defective. Then in that case, it has to be replaced. The repair also has to be taken care of, or for replacement has to be done. In all these cases, when the exports are done, this does not require export declaration form. So we used to call it as earlier waiver of, it's a GR waiver. That's how we used to call it, right?
And a very nicely highlighted about samples,
Thank you.
trade declarations are goods or government of India body taking an aircraft, and also up to 5 lakhs the professional or a gift that is given, and any equipment defective within 6 months is that very nicely highlighted about the waiver situation in respect of which the form or declaration need not be, or an exemption from giving the declaration. Thank you very much. Dr. Raju, there is a declaration to be given, there are exemption situations. If I am supposed to give the declaration, to whom, the authority to whom the declaration should be furnished, Dr. Raju?
Okay. Now, let me make one point very clear that when goods are exported outside India, exporter have to give a declaration called EDF. The form number is called Form EDF. Once upon a time, it was manual. Now, Reserve Bank of India has facilitated the submission through online mechanism also. But now, it is to be first submitted to the Commissioner of Customs. So let us be very clear about it. So Commissioner of Customs has to verify whether the export has taken place or not. So this form submission is a voluntary declaration, and one more thing, we have to also mention the value also, and the value is based on the invoice. Now I want to make one observation here. First, let me complete goods, then I'll come to services. So in goods, based on the invoice and based on the shipping bill, because shipping bill will be prepared, and based on the shipping bill documents, one additional document will be this EDF form. It has to be submitted to the Commissioner of Customs. Commissioner of Customs, after verifying that form, it will be in duplicate. Duplicate will be sent. The Commissioner of Customs will send the original form to the nearest Reserve Bank of India. For example, the port is Tuticorin. So, Tuticorin Commissioner of Customs, if I submit, which is the nearest RBA southern region, will it be Kochi or will it be Chennai? So, maybe he will submit to Chennai. So, the duplicate will be given to the exporter, and the original EDF will be submitted to the nearest RBI with the chapa and the countersign of the Commissioner of Customs. So, this is the regulatory provision. Second part, let me come to services. The form is called as soft text form. The soft text itself is the acronym for software exports. Now, VVSG, at the beginning, you were referring to with respect to, because you were connecting to the GST perspective with respect to the taxability part of it. I'll make 2 points very clear. Number one, software exports is only software can be exported outside India as a service, not necessary. Even it can be a service. As a chartered accountant, as a consultant, as a management consultant, valuation services, okay, for a client outside India. It can be a medical services for a client outside India, for a hospital outside India, research, anything. Now, services exported outside India, invoice raised. Do we have like a soft text form, some service text form, something like any form? Is there? No form. Presently, as far as export of services other than software export, no declaration. The only requirement is the invoice I will be generating. The government, the provision under the law is the money has to be brought into India within some time. That will be the very important question, because there are a lot of aspects are there with respect to this. So only that. So 1, 2, 3 goods EDF form, software soft text form. But soft text form I will not submit to the Commissioner of Customs. I will submit to the respective officer, the respective officer of the Ministry of Information Technology. So we can call it as a designated official of the Ministry of Information Technology, Government of India. Especially, I may be submitting to the STPA, Software
Yes.
Technology Park of India, or the Free Trade Zone, or SCZ. So these are all the respective authority to whom I will submit, but I will submit in triplicate. But as per the regulation, EDF in duplicate, but now they insist practically triplicate also, because one copy they will retain. And even the custom house agent and all, they say soft text triplicate, this also triplicate only. So regulation will only say duplicate, but practically we are only submitting triplicate, because the third copy is retained by the authority, original sent to RBI, duplicate given to exporter.
Dr. Raju, you very clearly highlighted about the distinction that is involved in respect of export of goods, and as well that of the services using soft text, which is applicable only in respect of software. In respect of other services where there is no prescription specifically, there is no need to submit anything to the designated authority in respect of export of services other than software. Very nicely highlighted about that. Also about the EDF and other portal and all. Madam, I have exported either it is goods or services. What is the time period prescribed in this regulation within which I have to realize the process of exports?
Actually, if you look at it, like originally, long back, initially, Reserve Bank of India had a different treatment, partial treatment for 100% export-oriented units, or special economic zones, or status holder exporters, or all these electronics, hardware, technology parks, vagera. Like this, it was like within 12 months you have to realize the export process. Then it was changed to 9 months. That is from the date of exports of goods or software or services exported from India. The proceeds should be realized, repatriated to India within 9 months, or the period may be specified by Reserve Bank of India time to time. They may keep changing. Like for example, what they did during pandemic, they brought in like this 15 months. They gave time 15 months from the date of exports for those exports which have happened before July 20, right? So, but now it's all 9 months. But there are cases where there is something called consignment exports. When I say consignment exports, it's not a sale in my book today. I have exported the goods. It goes to the warehouse, which is outside India, right? So the goods are exported to the warehouse, which is established outside India. But from there, it will be slowly released as and when it is sold, the proceeds will come. So it may not happen in 9 months, right? So there the time given is 15 months. So actually to sum it up, it is 9 months in all the cases, export of value of goods, software or services. From the date of export, the proceeds should be realized. If it is exported to the warehouse, if it is called a consignment export, the proceeds should be realized within 15 months from the date of export.
So thank you very much. It is 9 months. In extreme situation of pandemic, it was specifically extended 15 months, and consignment exports are also maximum of 15 months. Thank you very much, madam. Now, Dr. Raju, the law says or regulation says something. Reality is otherwise the best example. Two sets of form, three sets of form. What drives the procedural part of it? In reality, in transaction also, what happens? So the law prescribes the reality is dynamic and changing circumstances. I may not be able to realize the process within the stipulated time. What happens? What are the consequences if I don't realize within the time prescribed?
Very interesting question. It is a very serious question also. I'll take this question in two parts. First, I'll give you a Rajinikanth movie masala type answer or a Bollywood style answer. So you export goods or software or services, raise an invoice. I must realize the proceedings within 9 months from the date of export. As far as the soft text is concerned, it is the date of invoice is the date of export. Now, how I will realize? Only through authorized dealer. Now, there is another possibility. Okay, that the person is not able to pay me. Can I ask a third party to pay me? I have exported to Germany, but payment is coming from Australia. Can I say I have met the conditions with respect to receipts of export proceeds, provided there is a triparty agreement, and the triparty agreement has been submitted at the time of declaration, then this third party payment can be accepted by the authorized dealer. But post receiving payment from a third party, mentioning that this Australian dollar is only for the export made to a Germany in euro, so that will only create confusion, and also the genuinity of the transaction will be questioned. Another interesting twist. Slowly, I will add. I will bring the villain. Okay, so in a normal soft film, you when villain come only, it will become very interesting. The third villain will be uh, whether I have billed the invoices in a currency. In India, we call it as freely convertible currency. Not all global currencies are freely convertible. Say US dollar, Japanese yen, euro, Great Britain pound sterling. So these are Australian dollar, Singapore dollar, so UAE dirham. So India, certain currencies are only freely convertible currencies. So I raise an invoice in UAE dirham, but I am getting the money in Singapore dollar. Is it acceptable? AD will accept, provided you have to explain the business circumstance. At the end of the day, AD has to be convinced based on the business circumstance, and two points has to be very clear. Transaction should be genuine, and the business case is actually driving with respect to realization in this model. Now, let me go to a delay post 9 months. What to do? Reserve Bank of India, the regulation 14 is very, very important here. There, the wordings that is used is the Reserve Bank may give to any person, may give. That the word is called may give. So that means through authorized dealer, maybe to entitle to secure the payment thereof for the goods or software that has been. This wordings is very generic. So what it makes very clear is post 9 months, the obligation is on the authorized dealer to actually find out the genuinity of the transaction, and can the payment, if it is not realized, can be written off? Yes, we need the reason. No, 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 panam varadu, money will not come. These are the reasons, not traceable. That reason, this reason. So that information has to be actually informed to RBI, and this is a FATF. We have a WTO agreement worldwide. So all the central banks, these information has to be shared. There is so and so party to whom the transaction has been done, and he has duped our country. So therefore, these information have to be shared. So therefore, it is no wrong. For example, I have been duped because I have exported and payment does not come. Does it is not a, it is not a criminal, I will say, an activity. But I have to say that whether the transaction is genuine or not, sometimes the export will be done to country one, and from country one it will be further shifted to country two. Money will be received to country one, but it will not be remitted to India. So the genuinity of the transaction is where the authorized dealer will focus with respect to delay in receipt of payment, or worst scenario, the bringing back the goods, what we call it as re-import of the goods to India. Services, it is not possible, but in case if there is re-import is possible, that also can be, the AD will find the possibility. So this is what with respect to regulation 14.
So, authorized dealer is cast with the responsibility to maintain follow up and to see to that money is receivable back, or foreign exchange is brought back, or in case of an extreme situation, unless there is a collusion or otherwise or any other genuine transaction, genuinely there is a likely possibility of a money not realized at all is also, the RBA is also, time may be granted through the AD or whatever it is you have highlighted about it. Now you mentioned about goods and the software. In earlier situation, you were touched about the other type of services export also. I think the terminology, what are the logic, what is applicable to services is equally applicable for all types of services also. Correct?
Correct.
Thank you. Thank you. And I'm able to, Madam Lalita, I'm able to visualize in physical terms whenever goods are imported into India. It comes through the customs, we pay the duty and home consumption, whatever it is. There is a terminology used here, project imports. What is the terminology? What is all about project imports, Madam, under these regulations?
Here there is a small correction. As we are dealing with the exports, it's project exports actually.
Oh, project
I
exports.
mean,
Sorry.
not imports. Yeah,
Yeah,
exports.
project exports.
Yeah. So when you talk of see project import is same thing only, vice
Yeah.
versa, right?
Yeah.
So so we'll stick to export this time. Maybe
Okay. Fine. Fine. Fine.
when we talk
Fine.
about imports, if you don't
Fine.
mind.
No,
Yeah.
no, no.
So when we talk of the project exports, basically, it's not going to be realized in 9 months, right? It's a we may be undertaking a project, a turnkey project outside India. Like it may be like construction of roads or infrastructure development outside India. It's a civil construction contracts abroad, or it is export of engineering goods on deferred payment basis. You know, like the value is very high. It's a capex, right? So in all these cases, it's called project exports. For normally, what are the procedure for doing the project exports? Like I need to participate in the tender and all that. So global tender. So there are certain requirements, basic criteria is required. And that's not a problem. RBI allows the project exporters to do all that. But because it is too big a volume, the value wise, it is too huge. Normally, Exim Bank is involved in it, or there could be an AD1 bank also, which would also be involved in it. So, when do they come in the picture? If it is Exim Bank or an AD bank, we come in the picture only at the post award stage. After the contract is awarded to the exporter, before they start the implementation part of it, execution of these contracts, here they will have to approach the AD or Exim Bank, whoever is doing this financing for them. So there is a separate memorandum of instructions called PEM, Project Export Memorandum, on project exports manual, we call it. So it's called PEM, and that has to be looked into for all the clarifications that we need in this whenever we go for a project exports or financing a project export as a banker. So earlier, like what was it like? There were a lot of restrictions. There were not flexibilities. It was like, for example, I'm a company like L&T. L&T has been. I have handled cases like wherein L&T has been awarded a big project, say in UAE, in one of the Emirates. They may be awarded another contract in the other Emirate, right? Looking into this performance. So they'll have a machinery lying here, which has to be brought back to India and then brought again exported to the other emirate. Or there may be some funds lying here, which has been taken outside India already, but which is lying there. I need to bring it back and then again send it. Or there may be some cash surplus I have taken for my expenses, but I did not spend so much in Ras Al Khaimah in UAE, right? But I can use it for the contract which I have been awarded at Abu Dhabi. So all this has been allowed now. So much of flexibility has been brought in here. I can take the machinery from one site to another site, from one country to another country after completion of the project over here. I can transfer the funds which is lying in the foreign currency account, which I've opened outside India to, handle, execute a particular project. On completion of it, I need not bring it back to India. I'm going to lose lots on exchange. So I need to take it to the other country. Is it allowed? Yes, it's allowed. Okay. Then whatever is the cash surplus I have, which I thought I projected, I got the loan sanctioned by my bank as a project finance towards my expenses, administrative expenses or overheads or the cost towards execution over there in a particular country, say in one of the Emirates. Now there is a surplus. I didn't spend so much. The project is over, the billing has been already raised, invoices have been raised. So either I'll receive the funds or I'm going to receive whatever. So, but there is an amount lying in that account. Can I transfer? Yes. It's a cash surplus. I can take it outside. In case of software, again, you're so much interested in software contracts. Like, for example, it's an on site software contract. Earlier, it was like this. Whatever is the value of the contract on that, 30% of it should be brought to India immediately, on completion of a particular level and stage like that. But it is not so. They can repatriate the profits of all these on-site contracts after completion of the contract. So a lot of flexibility has been given in project exports and of goods and services exports. We need to refer to the PEM, basically.
Thank you, madam. You have explained about the project exports with live examples and the flexibility adopted these days with respect to the realities that exist. In line with that, the regulations were framed and implemented is very nicely in a detailed fashion explained with respect to project exports, which is ulta of project imports. Okay. Dr. Raju, whenever we export goods or services, there are these guidelines are applicable. Can I export Indian currency to any foreign country if it is whether it is a goods or services, what is that currency and how it is, if at all permitted, how it is to be
As per goods definition, under the Sale of Goods Act or under the Goods and Services Act, Central Goods and Services Act, cash is not goods. Cash is not goods. But so therefore, export of cash will not be considered as export of goods. But there will be requirement to take cash maybe along with the goods for certain purpose, like for a certain expenditure or for transaction purpose. So they have given certain limits, and that limit is 25,000. And is it per annum or per transaction? The wordings is any person resident in India may take outside India an amount not exceeding 25,000. So when he is crossing the border, he can take 25,000 as cash outside India. So like a baggage currency, like a baggage currency. Similarly, a person who is resident outside India, who is coming to India, he can be a foreigner also. When he is exiting the airport, can he take Indian currency? Okay, because that is where the Hawala will come. So there is a limit for Hawala. So that 25K is the limit. Anything beyond 25K, so will not be permitted to take outside India. So for
But
what purpose the direction is silent? In the regulation, nothing is mentioned, but in the direction given for the authorized dealers. So when I am saying, especially when the currency is there with me and the customs official or the airport officials are checking, what is this INR you are taking? I can show the master directions that I am permitted to take 25K outside. I need not explain the reason.
very nice. Without telling the purpose, up to an INR of 25,000, you can carry referring to the respective clause in the AD, in the master directions. We hear about export of goods or services. There are very many types of transactions. One such variety of category of transaction is leasing or hire purchases. Madam Lalita, whether this is permitted to, to an Indian resident to carry out export of any machinery under leasing or under hire purchase transactions.
Yeah. What happens is like, fundamentally, what does FEMA say is what we need to see. Whenever what is the RBA's problem here is what are they concerned about is apprehension is about what is the equivalent value of the goods or services that have been exported should be realized in foreign exchange within 9 months or 15 months as the case may be, and whenever it is required extension of time is required given, or it may be under deferred payment. Okay, because that is where like the genuineness of the contract is ensured. The underlying has to be genuine in foreign exchange always. When it comes to export of machinery, I can assess, the customs can assess the value of it. So that's why it has to go through the customs, you give the edf, the eda port, all that we have discussed, right? But when it's not the equivalent value of the machinery, it's going on lease or rental or hire. So who is going to fix it? So that is something where everyone is totally not clear. So what do they see here? No, here the exporter cannot export just like that and raise an invoice for an X amount, because here money laundering could happen. Like the difference amount could be parked elsewhere and all that. See, that is something very interesting that we can always discuss that later in one of our series. Where and all you see that you need to plug the loopholes there. So here what RBA says, no. If you are doing anything, export of machinery or equipment, vagera, on lease or hire, or that's on under some agreement with the overseas lessee, that X amount of rental or hiring charges will be collected, and then ultimately it will be reported to you. So you don't know what went outside, what is coming inside, and what is the value of the rental, whether you are right in getting it. So here, the exporter has to seek permission from Reserve Bank of India through AD1. It will go to the local regional office of the Reserve Bank of India for approval only and there the entire particulars of the goods which are exported and what is the industry rates, everything is given to them, and they compare and then they take a call and give the approval if it is right transaction.
So prior permission is a prerequisite to
Yeah.
carry out the leasing or HP because of
Yes.
various
Yes.
implications
Yes.
highlighted by you, be it Avala or fixing the value. There are so same goods going and same goods staying at the time limitation, realization 9 months or extension. All these are the related nuances which makes and forces this
Yeah.
type of prior permission. That's nicely explained, madam.
Thank you.
Dr. Raju, can you highlight what is explain foreign currency account, and also there is a terminology called EEFC account, EEFC, EEFC account. What is all about? What is your explanation for this
Mm.
foreign currency
Both
account?
the accounts are foreign currency accounts.
Yeah.
Foreign currency accounts are accounts opened abroad. EFC accounts are accounts opened in India. Example, EFC account is an account opened in Bank of Baroda, Bank of India, Bank of Maharashtra for by an exporter. So after raise an invoice, a normal transaction, the money will come from abroad. Now, I don't want to convert that foreign exchange in INR. So I want to keep that in foreign exchange itself for various purpose. For example, I want to meet my export obligation, sorry, import obligation. I want to make payment outside India. Second, I have taken some borrowings outside India, external commercial borrowing. I want to pay that, so I can offset it. So this EFC is a account that will facilitate such kind of exporters. Now, what is a FCA? Of course, in a chartered accountant circle, it is fellow chartered accountant, but here it is foreign currency account. That means opening an account abroad. For example, I open an account in Singapore dollar. I open an account in US, in San Francisco, in US dollar. For example, I have a branch, an Indian office, Indian company having branch in US. Can I open a foreign currency account in United States, San Francisco, and transmit? Can I remit money abroad for the expenses that I can do? So that is the reason for an FCA. Reason one. Let me give another example too. There is an international exhibition, trade fair. There is a general permission given. For example, there is a in Dubai there is a global international fair. So some of the Indians they go there. So for 1 month or 2 months that fair will be there. So they can open a foreign currency account there, do the transaction, and then collect the money in the local currency, which will be a foreign currency as far as India is concerned. And within 1 month of the closure of the exhibition, this is the condition. Within 1 month of the closure of the exhibition, the account should be closed and the money should be remitted back to India. This is with respect to general exhibition trade fair. The general permission is given. No need to have a special permission from Reserve Bank of India. Similarly, units in SEZ, they can open the foreign currency account outside India. Similarly, a project exporter, just now Madam was explaining, so they may also open account outside India. So these are all foreign currency accounts and EFC accounts. So maybe if Madam wants to supplement on this.
Madam Lalita, can you supplement and highlighting anything on these two foreign currency accounts and as well EWFC account?
No, actually, foreign currency accounts have been explained in detail very well by Dr.
Right,
Raju. Thanks
nice.
to him. I think EFC, you want me to supplement something,
Please,
right?
please, please, madam. Please, madam.
Yeah. So when you look at exchange earners foreign currency account, like as he said it very rightly, who can open it? The resident individuals can open it. A foreign exchange earner can open it. Like it could be somebody like us who goes outside India and we earn, we do consultancy or we do training programs and we earn in foreign exchange. Okay. Or we are exporters, we earn in foreign exchange. I may be requiring for payment of my imports. Then why do I have to convert it into rupee today? So in all these cases, it is allowed to open an EFC account with a local bank, as he said very rightly, with Bank of Baroda or Bank of India or any bank for that matter, which is authorized to open such accounts. What are the rules here? If you see, if I'm a resident individual, I can have a I can have a joint account with a close relative, and the account can be opened in such a way as permitted as per the Companies Act 2013, the close relative definition, with a former or survivor clause. Okay. And I'm an entity. Can I have? Yes, I can have a separate EFC account. But one condition is like whatever is exchange realized, out of the exports or the exchange that I've earned, 100% of it I can keep it in EFC account with the condition that the subsequent month, the succeeding month, the next month, before the 30th, I should convert it into rupee. That's the main idea behind it, like, so that it is not hoarded in foreign currency and it is converted into rupee. So this is again, something what RBI always follows, like this percentage is changed according to the requirement for stabilization of the rupee value and other things.
Very
And
nicely said.
and one more thing, I'm so sorry. One more
Please.
thing is, like, this EFC account, whatever is a balance available, there should it's a non-interest bearing basically, and whatever is a balance available, you cannot fund against that. You can't give a fund-based limit or a non-fund based limit against that, right? And also, if there is any import commitment is there, until then it can be retained, but that is again separately, it has to be taken up. That's,
And
So
it
there
is
is
a current account, and it is a current account, non-interest bearing.
yeah, it's a current account.
non-interest bearing and current account is the negative side of it. But if there is a commitment immediately, next month end is the timeline normally, with an exception when there is a need. Probably there may be some internal procedure through AD or control if there is a relatively longer time. Very nicely, the words cannot express the feeling of the gratitude for sharing knowledge within the given time for a limited question, but so much is there. Both of you shared your expertise in this field. Raju, there was one question, it appears somebody made a question. Can you see that and address
Yeah.
yours?
What about merchant exports? I
Okay.
don't know on what context this question was asked.
What is the question?
No. I think it is the context is not clear, so we can ignore it.
Okay.
Okay. Thank you very much for sharing the knowledge. And this is one such a 10th episode, very casually started. So much has been shared by both the speakers, Dr. Gopalakrishna Raju and Madam J. Lalita. Thank you very much for on my behalf and on behalf of all the persons who are watching this one. Thank you, Madam. Thank you, Dr.
Thank you.
Raju.
Yeah. Thanks
Thank
so
you,
much.
VVS sir, and thank you, Lalita madam. Thank you.
Thank you, GKR, and thank you, Mr. Sampath.
Thank you.
Thanks.